Everyone. Thank you all for joining us today. I think I've met pretty much all of you here today, but for those of you that I haven't met, my name is Anne and I'm from Sanlam Private Wealth here based in Mauritius. And I'm the Senior Wealth Advisor looking after all the UNFCU members who are invested with us, more particularly in the AI portfolio. I'm very pleased to be hosting the webinar today to look at the current issues, the current market performance, the current AI portfolio performance more particularly. And I have Jorge with me here, which I'll introduce shortly. But just to give you a brief, much or about the AI portfolio and that you've been invested in. So as you know, the AI portfolio is not like the other traditional investments because it is driven purely by the AI engine. So it's 100% driven with AI, with the predictive investment engine actively recommending the asset allocations on a weekly basis. The AI aims to address investors' primary concern, which is the risk of capital loss and timing loss, by providing a solution that can proactively adapt as quickly as markets evolve in order to supply our investors with improved investment outcomes. We're very pleased here today to have Jorge joining us. So Jorge is based in Miami and is the Vice President for Americas for Sanlam Global Investment Solutions. Jorge has a wealth of experience in the investment industry, more than 20 years in private banking, with experience with high net worth clients, with wholesale and retail from the US onshore, offshore, LATAM markets, and he has held various significant positions in his career. And he will be giving us today a presentation more particularly on the AI, but also looking broadly at markets. How has the markets performed, where we're at currently, and what is it that we can expect going forward? I know that's very difficult to predict, but based on all the information, all the intelligence that we have within the group, within the Sanlam group, so we'll be able to give you, I guess, a more broader overview of what is happening and what is it that we can look forward to. How has the market performed? We all know that the performances this year has been impacted every month now that we've seen the performance in our portfolio. So hopefully that will give you more guidance as to what is happening and what to expect in the future. So I'll just hand it over to you, Jorge. So by all means, if you have any questions as we go through, please, you can put them through the chat, or alternatively, we have a Q&A session after the presentation. So the presentation will go for about 20-25 minutes, and then we'll go through for a Q&A. So if you have any questions, get them ready and we can address them towards the later part of the webinar. Thank you. Over to you, Jorge.
Thank you, Anne. Thank you very much. Thank you to you and your whole team at Sanlam Private Wealth Management for the invitation to speak this morning. I am coming from Miami, Florida, so good morning or good afternoon where you may be. And I think in terms of Anne, I think your positioning is very precise. We've obviously living through a period of heightened volatility in the markets and the economies. And so my objective for today is to provide a little bit of perspective in terms of where we are in the economy, where we are with the financial markets, and then look at it in detail in terms of interest rates, in terms of inflation, and how does that impact the underlying indices, the underlying instruments, the underlying investments that the AI solution is investing in. So for the next 25 minutes, I'll go through some information and then we'll leave it up for some Q&A. So I appreciate everyone participating in the call today. I will share the screen here and we can start and I'll share some interesting information. Full screen. In terms of Sanlam, everyone is aware of it. But again, I just like to highlight Sanlam is over 100 years old. It's a public company listed in South Africa. Our main offices are in Cape Town, and we have offices, as you can see, throughout the world. A+ rated by S&P 500, over 50,000 employees worldwide. presence in over 42 countries and close to 70 billion in assets under management. And Sanlam provides asset management, portfolio management, wealth management, insurance products in the various markets. So it's a global, a true global financial services firm. When we go to sort of a market update, and where we look at, well, what are the main concerns, right? And the main concerns after we finished off, I think 2021, a very strong year, and even the 3 years prior to that, 2021, 2020, 2019, and 2020, including the pandemic, including when the world basically shut down for a couple of months to hold off to this pandemic, we had a very sharp decline in the markets, but then we had a very sharp recovery. So we come from three very strong years, and then we go into this year and we sort of have these, five or six main concerns, where because of the 2020 and because of everything that was done to the markets to assist in the pandemic, now we have this sort of inflationary environment where it's really causing dislocations in the near term. And so what I hope to address in these next 20 minutes is just to provide reference on interest rates from a US perspective and from a global perspective, and how those interest rates affect investments. How do they affect the indices that we invest in? I'll also touch on the US Federal Reserve policy, the Central Bank of the United States. They pretty basically set the interest rate policy for the world. The other central banks, the 5 other central banks in the world, follow the US Federal Reserve. So we'll look at in terms of what's their stance. They've been very aggressive in fighting this inflation, and they've risen interest rates very significantly and aggressively this year. So we'll talk about that. We'll talk about inflation. We haven't had inflation numbers that we've seen in over 40 years. So we have very high inflation numbers. The question is, will this inflation persist, right? And I think the Federal Reserve president and the U.S. Federal Reserve, what they've indicated is their primary concern at this point is to maintain inflation. And so how does that impact the markets, right? We'll take a look at in terms of performance on the fixed income and equity markets. Those are the things that the AI solution invests in. So where we're looking at, U.S. treasuries, U.S. corporate bonds, global corporate bonds, global equities, what has been the performance given, this inflation and given this central bank policy in terms of the cost of money. We'll talk about the economic slowdown. Obviously, from a U.S. perspective, they're trying to hold off some of the demand that we've had, and because of that strong demand, we have that inflation, and so we will see in terms of what that economic slowdown looks like, and then we'll provide some perspective on this equity market correction. We're sort of in the correction phase where the markets have come down 20%, and we can look back historically and say, well, when we've had these types of corrections, do we get through them? How do we recover? How fast do we recover? And so again, it's just to provide hindsight, and then we'll look at the AI portfolio's performance. So with that, I'll continue here. So in terms of starting, and I'll go through these slides, and this may look a bit technical, but I'll explain it. So from a monetary policy is what the central banks dictate, is the cost of money, the cost of capital. And so we see the main 4 central banks in the world. We have the U.S. Federal Reserve, the Bank of England, the Bank of Japan, and the European Central Bank, right? And they coordinate interest rate policy, for the various markets. And we can see that in terms of looking at this chart, we are coming off from a very low interest rate environment, right? So we have to go back to where we had the great financial crisis of 2008, 2009, when on the onset of the financial crisis, all the central banks brought interest rates down to 0, right? So we had very low interest rates. The U.S. Federal Reserve increased interest rates a couple of years ago when the economy was growing, but then we can see in the pandemic how we've had this again. In the pandemic, they brought them down to 0, and now we have this inflationary environment where they're all now increasing in an aggressive manner. Usually, you can see when they increase interest rates, they go sort of in lockstep. Here, they've been a little bit more dramatic, a little bit more aggressive, and again, it's to hold off this inflation. So that's sort of from monetary policy, what are the central banks doing? And then we can see on the right hand of the screen, we can see these are called the yield curves, or the interest rates that you get, the interest rate policy that the central banks indicate. So you can see that in a couple of charts I'll show in terms of how has this changed over the past year. But we can see that Bank of Japan, so interest rates in Japan remain very, very low, so almost at 0%. The European Central Bank has increased interest rates, but not that much, not as much as the United States, because in Europe, obviously we have the issues with energy, we have the issues with uncertainty with oil and so forth. So the economic growth in Europe hasn't been as high as has been in the United States. And then we see the Bank of England increasing interest rates very significantly, and this is basically to hold off the pound. So we've had the US dollar appreciate also very strong this year. And so the Bank of England increased interest rates to hold off the depreciation from the pound. And we saw that the pound was pricing at very historic lows to the US dollar, right? So we also have some dislocations in the in the currency markets, where the euro now is fallen below the US dollar, right? It's broke the dollar, and then the pound was sort of nearing the parity with the US dollar. So the dollar, the currency, very, very strong. Again, it's not good to have these very big movements in such a short amount of time. So that's a piece on interest rate policy. If we look what we were, and this is an interesting chart, on the left-hand side of the chart, we can see from a U.S. perspective, this is called the U.S. Treasury yield curve. And basically this shows the difference in interest rates between short-term treasuries, 3 months, 2 years, 5 years, 10 years, and 30 years, what those yields or interest rates were a year ago, what they were a month ago, and what they are today at the end of September. And so we can see a very, very big significant change, right? From a year ago, the two-year US Treasury yielded basically about 0.2%, very low, close to zero. We fast forward, to a month ago, and we see this very, very significant increase in short-term rates. And then even in the past month, we've seen even further increase in short-term rates. So the question is, what does that translate? What does that mean? Well, that means in terms of when we look at performance, right? And so we're looking at if we look at 12-month performance for US Treasuries, which US Treasuries, by definition, they're considered risk-free, meaning that the probability of the United States to default on their debt is very, very low, right? So if you were holding, a 5-year Treasury bond or a 10-year Treasury bond, meaning that you're basically taking very little risk, right? 12 months ago, the 10-year Treasury bond had a yield or an interest rate of 1.5%, meaning that if you bought a Treasury for over a 10-year period, they would pay you an interest of 1.5%. That interest rate now is 3.8%. So again, this is by the effect that the U.S. Federal Reserve has increased interest rates. What does that mean in performance? It means the performance that if you held that 10-year Treasury, you're down 16% over the past year. And if you go even longer into 30-year Treasuries, you're down 28%. So in a risk-free instrument, in a bond that's considered very, very low risk, but because we've had this very significant move in interest rates because of inflation, we see this performance in the U.S. Treasury markets, which we haven't had in a very, very long time. Now, the question is, okay, this is the performance. One of the questions we get, well, this is the performance. What do we expect going forward, right? So this is dependent upon inflation. So with once they contain inflation, we can see that, again, the rates will stabilize, and then we won't have this performance. But this is sort of to provide guidance in terms of, we've had volatility, yes, in the stock markets and the equity markets, but we've had more volatility in the fixed income markets. And I'll go into how the AI portfolios, they invest in these. So these are considered risk off. When we have a risk off environment, when we have a big correction in the equity markets, U.S. Treasuries tend to rise. The price tends to rise and the yields tends to fall. Well, here we've had the inverse. We've had equity markets fall, and also the risk, the sort of the risk off or the low risk instrument also fall at the same time. So we've seen that. If we look at this is a quilt chart just because of all the colors. And this quilt chart, what we do is we list all of the fixed income or bond sectors. So if we look at all fixed income, we look at treasury bonds from the United States, from Europe. We look at corporate bonds from investment grade, high quality companies. We look at emerging market bonds. We can look at high yield bonds. So we look at all the different options in bonds. Again, bonds, fixed income tends to be low risk. Outside of emerging markets or high yield, they tend to be very low risk. And if we can go back just by looking at this chart, go back 10 years, we can see that different sectors of the fixed income market do well in years. What's significant about this year is that if you go down at all of the bond options, they're all negative, right? And what's most surprising is when we look at sort of the last one, the global aggregate bond index. So global aggregate bond means that these are all the bonds from global companies, not the United States, global companies, mostly in Europe and Asia, but they're high quality companies, right? Nestle, Barclays, a lot of high grade companies. And we see that again, because of this interest rate policy, these indices are down significantly this year. So again, we haven't had a year like this in a very long time. Now, the question is, will this persist? And, the markets are cyclical, number one. We do have this, this volatility from time to time. But after a negative year, what usually follows is a correction to the upside. So as much as the markets come down in a correction, they also have been shown to recover very quickly as well. So this is on the fixed income side. When we look at the equity side, again, on the equities, and we look at, again, all of the different option of equities, if we look at international companies, US companies, emerging market companies, either large companies, small companies, again, we're all negative, and negative by a significant amount, right? And again, we haven't had this in a very long time. If you just look back at the last 10 years, we haven't had an all negative. I think back in 2018 is probably the most similar time frame, where in 2018, these different indices were negative. Not as much as this year, they were negative. But then we can see sort of the reversion back to the mean. We see the correction back to the recovery, and the following year we see a very strong recovery after a negative year. Now, I'm not saying that we're going to have a recovery in the following years. We're not sort of predicting the future. But if we look at history and we look at the way the markets behave and the cyclicality of the markets, we oftentimes see a recovery after a big correction. So this is also interesting because, again, the AI solution is looking to invest, to diversify into these types of sectors, and it's been challenging this year so far. I mentioned this is a chart of the US dollar index. So the US dollar is just looking at how the US dollar has performed against all of the major hard currencies, and we can see, going back 10 years that the US dollar has a very, very, very strong rally. And again, this is born from the central bank policy. Increasing interest rates puts obviously a lot of strength behind the US dollar. And so the US dollar has strengthened against the euro, the pound, many of the Asian currencies, many of the emerging market currencies. So we're at all-time high. Not necessarily good for assets, not necessarily good for the US economy. And so we probably will see, we'll probably see an adjustment, in the coming months for this, right? And so when we look at, let me just move this thing out of the way. So when we look at sort of, okay, so the first part is, okay, we've seen the performance on the fixed income markets, we've seen performance on the equity markets. When we look at when we look at performance after we've had sort of a big correction, right? So after a bear market, or after we've had a decline of more than 20% on the S&P 500, and again, the S&P 500 is top 500 companies in the United States. So it's Google, Amazon, Microsoft, Apple, those types of, global companies, right? Global companies that tend to be the market leaders. When we have a 20% decline, and we're going back again, we're going back 60 years since 1950, after 20% decline, what follows after that is a recovery. So when we look at this chart is looking at the blue is when the bear market begins, and then the green bar is 1 year after. The blue bar or the dark green bar is a 3-year, the performance 3 years after, and the yellow is the 5 years after. So we can see that after a big decline of 20%, going back since 1950, looking at all the market environments where the market corrected more than 20%. So the last time was in March of 2020. We had December of 2018. We had August of 2011, July of 2008, the great financial crisis, and so on. So we can go back 60 years when we've had 20% declines, and we can see that what followed was a strong recovery, not only 1 year, but 3 and 5 years. So provide sort of hindsight in terms of when we have these pullbacks, the best thing we can do is if the investment horizon is medium to long term, if that hasn't changed, the best thing you can do is stay in the markets, because what follows after a big decline is a big recovery. And definitely missing out on a big recovery could be significant to performance. So we can see on average, what is the after a big correction, what is the recovery? On average, on 1 year afterwards is 22%, and 3 years afterwards is 51%. So a significant recovery. So that's something to provide in terms of hindsight, in terms of when we've had these types of pullback, what follows, and this is an indication. So this is saying, the U.S. equity market has entered into bear market. Bear market means that again, it came down 20%. So when it comes down 20%, what follows? And we don't have many corrections of these types. We have, every once every 6 years, we have a pullback of 20%. On average, if we have 3 corrections of 5% per year, 1 correction of 10% per year. But again, we don't have this that happen often. But if you go back again since, a very long time, since 1926, and we look at, well, the S&P 500, the batting average is basically saying, on average, what is the positive calendar years? How many positive calendar years have we had? And on average is 73%. 3/4 of the time we have positive years. 1/4 we have negative years. So we're sort of in this negative environment that, again, we think we'll get through this, because the markets have always gotten through, where there was the pandemic, the great financial crisis. We can go back to the 2000, 2001 .com and the corporate crisis. The markets have recovered from that point on. So again, this is a bit on inflation. So the blue line indicates the inflation rate. So you can see, from going back to 2018, we had very low inflation, or inflation that's within the parameters of the central bank policy. And then, then we have the pandemic, where obviously inflation went to zero because, everything closed down. And then because of everything that happened in 2020, again, we've had this high inflation, and inflation really picked up aggressively, right? And so we can see what the Federal Reserve interest rates is. They went from a zero interest rate policy for a very long time to where they are today. So that's happening. Now, we talked about interest rates. Let's look about the economy. The question is, well, how has the economy done? And so when we look at unemployment rate, right, jobless claims, that's unemployment, we can see that this is the U.S. jobless claims, meaning that how many people are claiming for unemployment. And we can see that, again, we're very low, jobless claim. So we have very low unemployment, which again is good for the U.S. economy, good for global demand. When we look at, it's kind of interesting chart here. This chart looks at how many job openings for every, there are 2 job openings for every person that's unemployed in the United States. So we look at this chart going back to 2002. So we're going back 20 years. And what this it's indicating is how many jobs are out there, right? So this line indicates that there are more job openings than there are people applying for it. So again, this is indication of the U.S. economy that's continues to do well. If we look at again, this is just inflation. That inflation has the headline inflation. If we look at headline inflation from the beginning of the year, the blue chart, the blue column, right, we can see that these columns are very high, and then in the last several months, the headline inflation has come off. So that's a good sign. Good sign meaning is that they're containing inflation. Now they have to sort of contain the core inflation that the orange bars needs to come down. But at least we start seeing that inflation is being contained, and so that's a positive sign there. This is expectations of where the interest rates are going to be, for the next several years. So we see that the central bank is going to increase. The Federal Reserve is going to increase interest rates to hold up inflation. Once that is contained, then they'll probably lower interest rates. If they lower interest rates, then that is good for bonds. So we can see that again when we looked at the bond performance in a couple of charts ago. We can see that the probably will have a recovery in the bond markets as well. So this is kind of an interesting chart. This looks at corrections going back 40 years. So if we look at corrections of 20%, this is not the first correction we've had. We had one in 2020 where the S&P was down 34%. We recovered from that. In 2007, 2008, the great financial crisis, the equity markets that were down 57%, we recovered from that. So again, we can go back and say we recovered from this markets. Most important thing on this is not missing out on the recovery, which is critically important for investors. The propensity for investors to do is in a heightened volatile environment, most want to either go to cash, liquidate. And again, if the investment horizon hasn't changed, if you're still investing for the medium to long term, then this chart is very important, because if you sort of miss the best 5 days of a recovery, that makes a very big change to performance, significant change to performance. If you miss the 10 best days of the market, you can see that you have that you just by missing a few days on the recovery or a few of the best days, then you can see that you miss out on performance, and this is what we want to obviously to avoid, right? So this is an interesting chart as well. This is interesting as well. So if we look at the S&P 500 and we look at presidential cycles, right? So and this is going back again 60 years. So when we've had big corrections during a cycle, and we're in the second year of the presidential cycle, we're second year of the Biden administrations, right? And we have congressional elections coming up in November, which is significant, right? When we look back, 60 years of data, right? When we've had a big correction in the second year of congressional elections here in the United States, we usually have a very significant upside following that 12-month, 12 month later, we have a very strong performance, 1 year performance. So we're down in the markets. We usually have a recovery after that. But we couple that we are in sort of in this second mid cycle of the congressional elections, we usually have a very strong recovery. So we have congressional elections in November here in the United States, and 1 year afterwards, we usually have again a positive side on the equity markets. So going back 60 years, and this is the average. So again, if we look at going back 70 years since 1950. And we look at midterm election returns. So what were the returns for 1 year in midterms from November 1 year forward? We can go back, at all of the midterm elections, if we've always had positive years. Again, not indicating that it'll always, that it'll happen in this cycle. But if we take history as an example, we can see that we've had strong markets after congressional elections. So that's kind of an interesting chart as well. Let's look at inflation. Once inflation is contained, what happens to performance on the equity markets? And here we can see, again, that the S&P usually has positive returns after inflation peaks. And it looks like inflation is peaking because we just saw the headline inflation coming down. And so if we look at, once inflation is contained, if we look at forward 3 months, forward 6 months, forward 1 year, when we've had these inflationary periods, right? So these are the high inflationary periods that we've had for the last, since 1958, for the last 60 years, we can see that once inflation is contained, that markets tend to recover as well. So again, another sort of positive sign in terms of when, they contain inflation on here. So going into the AI portfolios, and I'm running out of time. I'm running out, so I'll conclude in the next minute. So on the AI portfolios, we have 4 different portfolios. We have conservative, balanced, growth, and dynamic. They follow sort of the Morningstar, sort of how do we allocate into, how do we invest into these portfolios? And really what the AI solution is investing into these different indices, these different fixed income options and equity options. So on the fixed income option, we have short-term US Treasuries, long-term US Treasuries, international bonds, US corporate bonds, high yield bonds, and emerging market bonds. Just to give you an example, this instrument here, LQD, this has over 2,000 bonds in there. So a lot of diversification. So it's not just one, which is not betting on one company and one bond. There are over 2,000 bonds in this index. We have the S&P 500, which is the top 500 companies of the United States. We have the leading global companies, ex-US, and then we have emerging markets. So the AI sort of allocating, it's investing into these different types of in these instruments or these indices, and it's trying to find the best allocation, the best mix on a given week, right? So on a given week, it can change the allocation and it can alter it. The thing that we've had this year is that usually the safe instruments, the risk-off instruments, which are the treasury markets, we've had a lot of volatility in that. So it didn't matter if you were in the S&P 500 or if you're in the 20-year treasuries, you're down as well. So what we're doing, so we've been looking at this for the past probably 3 or 4 months, and we've gone into the marketplace and say, well, how can we diversify more? How can we provide the AI solution more options to invest in case when we do have this, this high correlation. Correlation means that everything sort of moves in tandem, moves in the same direction. So in the coming weeks, we will be providing information that we are expanding the investment universe. We're going to be providing more options. We're including a gold index, and we're including other instruments. And so we will be coming with more information, and you will see a change in the allocation and hopefully a change in performance, right? But sort of these are the indices. If we look at performance on the AI portfolios press the wrong one. There we go. If we look at sort of performance this year, whether you're in a conservative, balanced, growth, or dynamic, again, negative returns. If you go back and say, okay, in a normal market environment, 2021, 2020, 2019, these were the performance. So again, this is not, this is very atypical. And again, providing hindsight in terms of where we are in the market, where we are with inflation, where we are with the economic cycle, with the elections, with equities, and so forth. So this is a bit on performance. And then if we look at, for example, on the AI balanced portfolio, this chart looks at the each green bar is a 3-year rolling return. So this is a 3-year period, 3-year investment period annualized. So this is looking at every 3-year period, going back since these portfolios started. And we can say that if you hold this for a 3-year period, positive returns. Here we are with very low returns because we're here at September of 2022. And so we can see that we've had a 3-year rolling return, not negative, but very low return. So if the holding period is 3 years, you should be able to, hold, to maintain from the huge volatility. If we look at the AI growth portfolio, the AI growth portfolio tends to invest more into equities, into the S&P 500. And again, the orange bars is looking for a 3-year cycle. So this is every 3-year cycle. So it sort of averages between 8 to 10% if you take it the average. And then obviously we're, at the 3-year cycle here at the end of September. This is the end of August. And so, lower returns on a 3-year perspective. So the idea is we're investing for the medium to long term. Obviously, we're looking at short-term performance. We're very cognizant of that, very aware of that. And obviously, we want to make sure that we improve investment outcomes. We pay very close attention to volatility. And if we can do something to expand the investment options to obviously to manage this risk-off environment or to take advantage of the recovery that will invariably happen. The recovery will come as they've come in all the past markets. So with that, Ann, I passed my time by 4 or 5 minutes. So I'll open it up I'll turn it over to you for any questions.
Thanks, Tori. There's a lot of noise at the moment in markets, and as you've just described through one of your slides there, it's September ended at its lowest since November 2020, after third straight consecutive quarter of negative performance. I think the longest run, and you mentioned that as well, the longest run we've had since 2008, 2009. Similarly, global bond markets are also in a bear market, down more than 20%, even if we look at, so the S&P you mentioned, down more than 20, 21%, MSCI World as well, 23% down. So, and some, when you listen to all the noise that are out there, some are predicting that is it more pain that we are experiencing ahead? In your opinion, how do you think, and despite the last couple of days, we've seen that the markets have picked up since probably the last couple of days that we looked at the performance. But in your opinion, are we at the bottom? Have we seen the worst yet? And how do you foresee the next quarter will look like for our investors?
Yeah, good question, Ann. Look, September was very a significant down market. So what happened in September? September, the U.S. Federal Reserve they've been very aggressive on increase in interest rates. They started increasing rates, at 0.5% initially in March. Then they started increasing at a 0.75, almost 1% clips, which again, that hasn't happened in 45 years, right? And in September, it looks like the inflation, in this inflation, let me go in this inflation chart. What I was looking, let me go back to that one. See if I can go back. Because this is sort of looking. This is what happened in September, and this is where we had this here. So we had headline inflation that's coming down. But then the Federal Reserve said, no, we're not happy with headline inflation coming down. We were more concerned with core CPI, with core inflation coming down. And so they came in September and said, no, we're gonna be more aggressive. And so the market took that as well. They're gonna continue to increase interest rates, and we had a sell-off. Now, at the same time, by having that stance, it looks like the Federal Reserve is very serious about containing inflation. And if they contain inflation, it'll be good for the markets, right? And so I think, invariably, the messages from the Federal Reserve were they're going to be, they're going to pay attention to inflation, but they're not going to be as aggressive. Now they've changed their stance to say, no, they're going to be very aggressive, which in the short term, a little bit of pain. In the long term is good because prices will stabilize. And when we have price stability, then the cost of capital for companies will be stable. And then we should have a recovery like we've had always in the past. So again, I don't want to say we're sort of at the, in our view, we're close to the end of this. It's difficult to pick, exactly when the date comes, but we can look at data, we can look at markets, we can look at history and say, okay, when we've had these types of markets, what comes next? And it looks like what comes next is a recovery. If we look at the health of the U.S. economy or the global economies, there's still consumption, there's still demand. Companies are still very profitable. So it's just getting past this inflation stance that we haven't had in a long time. So once we get past that, look, there's concerns over in Europe with the conflict in Ukraine and so forth. How's that's going to spell out? We're going into winter months there. It's going to be, bad for each side, for each side of the conflict. So at some point they're going to have some sort of, they're going to go to they have to go to the negotiation table and settle some sort of, peace settlement. And so if that happens, that's also going to be very positive for the market. So again, I think we've had we've had obviously difficult markets, but I think we're sort of at the end of this, again, without trying to predict the exact date when we'll come out.
Thanks. You had a slide towards the beginning. It was the S&P 500 in the history over the last 50 or 70 years. S&P 500 being one of the major components of the AI portfolios. I believe it can be an allocation of up to 40% at any given week for some of the 3 or 4 different types of profiles that you have. So I guess as a closing statement, what I wanted to know or hear from you, or your thoughts or your views, what would you say to nervous clients at the moment, nervous investors? Because obviously everyone is concerned about the performance of not only of the markets, but more sort of closer to home, looking at their own personal portfolios from January this year, more particularly from January this year, year to date. We have seen some, obviously just a pure reflection of how the market is performing, but we have seen portfolios down by 15-20%. So I wanted to go back to that slide where you showed that performance after when we look at the trend over the last 50 years, and just have your views on that as well, Jorge.
Yeah, no, absolutely, and that's a good point. Look, we understand how our investors feel. We feel it ourselves. We understand the volatility, and the volatility that not only our clients are experiencing, but all the investors worldwide are experiencing. So you understand that, and so we understand how that feels. Many investors feel that felt the same way, but they found if the investment horizon hasn't changed, right? And if we understand the history of the markets, and we understand where we are with the things that I just mentioned, usually there is a recovery, and we've always had a very strong and there's a recovery, and the recovery comes very, very strong, right? As much as the decline and the drop off come, as has happened this year, we also have a V-shaped market too. We always have a very strong recovery. So, we can look at, when we look at, this is an interesting chart because it looks at the S&P 500 and it looks at the performance during the mid cycles. And again, this is going back 60 years and, always positive returns there. When we look, once inflation has peaked, the S&P 500 tends to do very well after that. So it looks like that's about to happen because inflation is being contained. When we look at, we saw this chart. This chart again is the fear of missing out, FOMO, the fear of missing out. This is very strong because if you sort of stay fully invested through the cycle, you will get out of it and you'll be performed just like we did in 2020. 2020 and April of 2020, the S&P 500 was down 35%. Had you sold at the end of March or at the end of April, down 35%, you'd have missed the recovery. The S&P 500 finished up 18% for that year. So had you looked from January 1st to December 31st, you would have had an 18% return for that year. But during the year, you had a 35% decline, right? And so again, it's the nature of the cyclicality of the markets. And so just looking with a bit of perspective to say, look, going and navigating through these storms. So that's also significant. We've had corrections, these big corrections in the past, and we've all recovered every single time. And the recovery doesn't take, years and years. It takes months, weeks in certain cases. And so our main objective is not for investors to stay invested in the products. It's not for our investors not to make mistakes, because the common mistake and the investors make is, again, they tend to sell at the worst time, at the low, because of the headlines that you see in the news, because of you see the account values. And so our objective is to say, provide, education, provide a little bit of hindsight, provide information in terms of, well, have we gone through this before? We have. What are we looking at the markets? And so there's always sort of a recovering that. And so this is the best thing that we can do, is just to provide some information in terms of where we are in the cycle. How do we recover from this? And staying put. I understand. I understand. We see it with our own investments. We see this volatility, and believe me, it doesn't please anyone to have this.
Yeah,
So
thank you, Jorge. Thank you for that. Thank you for your time today. I think we'll already a couple of minutes past our time, but if you have any questions, any queries, as always, I'm always available for. Don't hesitate to reach out to me for any questions, any queries that you have. You've got all my details, and I'm happy to then liaise with the team at Sanlam in the background there to give you as much information as possible. So that you make informed decisions and obviously try and ride this very volatile market that we're having at the moment. But we'll try and do those webinars. That's our third one actually that we've had. So we'll keep this as well going forward. But like I said, if you have any question, don't hesitate to come to me, and I will liaise with the team in the background and give you all the information that you need. So thank you very much, everyone, for your time today, and speak to you soon. Thank you, Jorge, for your presentation. As always, it was very insightful. Thank you.
My pleasure. I wish everyone a good day. Thank you again for all your support.
Thanks.